Imagine a massive commercial bank, right?
Hmm.
An institution that is just, well, entrusted with the life savings of millions of people.
Right.
Now, imagine that behind the scenes, this bank just decides to bypass critical anti-money laundering checks just to speed up onboarding for, high net worth clients.
Yeah, a massive compliance failure.
Exactly. They break a foundational rule of the entire financial system. And the question isn't really just how they get caught. The far more interesting question, and the one with, just massive implications for the whole economy, is who actually decides the punishment and, how do they ensure that punishment isn't just a slap on the wrist?
Yeah, and that is, it's really the defining question of modern financial regulation.
Oh,
Because for a long time, the public assumption was that central banking just operated like a vending machine. You
a
know,
vending machine.
yeah, like you put a violation in and a predetermined mechanical penalty just pops out.
Yeah.
But the reality of dealing with institutions that literally control the lifeblood of an economy,
Yeah.
it's far more complex than that. It requires a system that can weigh the intent behind an action, the scale of the damage, and the potential for a cascading failure across the entire financial sector.
Which brings us perfectly to what we are doing today. Welcome to this deep dive. Our mission today is highly specialized and honestly incredibly ambitious. We are taking Chapter 11, Enforcement in RBI, from your source materials, and we are going to just completely deconstruct it.
Hmm.
Think of us as your expert academic researchers and like your instructional designers. We aren't just summarizing here. We are building an exhaustive, text-based blueprint, like an audio infographic of the Reserve Bank of India's enforcement architecture.
Absolutely.
If you are preparing for an exam on this topic, our goal is that by the time we wrap up this conversation, you will have such a deep conceptual understanding of the mechanics, the history, and the philosophy behind these rules that you are never going to need to read the chapter again.
That's the goal.
We're mapping out 7 specific layers: the core concepts, the timeline, the precise terminology, the important figures, the crucial data points, the cause and effect relationships, and finally, the global comparative matrix.
And, the value of this approach is that rote memorization just fails under pressure.
Oh, completely.
Like if you only memorize that a certain committee has, say, 3 members, a complex exam question can easily trip you up. But if you understand the structural necessity of that committee, how it functions within the broader ecosystem of the central bank, and why its powers are limited in specific ways, well, the facts just lock into place naturally.
Yeah, context is everything.
Exactly. We're going to explore the underlying logic of the Reserve Bank of India's Enforcement Department.
Okay, let's unpack this. We need to start with the foundational shift that Chapter 11 introduces. I'm calling this core concept, if you're taking notes, the shift to centralized discipline.
I like that title.
Thanks. Because the entire chapter really revolves around one massive evolutionary leap for the RBI, moving from this scattered, ad hoc system of punishment to a highly centralized, rule-based enforcement department, which we'll just refer to as the EFD going forward.
Right, the EFD.
And the stated 2-sentence summary objective here is to firmly separate enforcement from supervision.
I want to spend some real time on this because it seems to be the philosophical bedrock of, well, everything else we're going to discuss.
It absolutely is the bedrock. To grasp why the EFD was created, you have to understand the 3 distinct facets of financial sector oversight that are defined in the text.
Okay, well, hear them.
They are regulation, supervision, and enforcement. Let's define the boundaries of each. First up is regulation. This is the legislative phase.
Right.
It is the act of setting the framework, drafting the actual rules, and determining the parameters within which financial entities must operate to ensure prudence, transparency, and consumer protection. So if we use a sports analogy, regulation is the rule book. It dictates the capital requirements, the liquidity ratios, the protocols for verifying customer identities. It's the architecture of the game.
I love that analogy. Yeah,
Right.
it's the rule book. Now, the second facet is supervision. Supervision is the active, ongoing monitoring.
The day-to-day stuff.
Right. It includes both off-site surveillance,
Yeah.
so analyzing the massive amounts of data that banks submit, and on-site inspections, where teams actually go physically into the banks to review their books and their practices.
Okay.
The supervisor's job is to check if the entities are actually adhering to the regulations that were set in Phase 1.
So back to the sports game, I picture supervision like the referee on the field. They're running alongside the players, they're watching the tackles, looking for offsides, and, blowing the whistle when they see an infraction in real time.
Yeah, that fits perfectly. But then we get to the third facet, which is enforcement.
Right, the enforcement.
Enforcement is the specific mechanism for dealing with cases of noncompliance. When the supervisory process, or maybe some other intelligence, uncovers a breach of the regulations, enforcement steps in to handle the penal action. It is the adjudication and the sanctioning phase.
Which perfectly extends the analogy. If the supervisor is the referee on the field, enforcement is the league's disciplinary committee sitting in some boardroom on a Monday morning.
Exactly.
They are reviewing the game tape, looking at the severity of the foul, and deciding whether to hand out a massive financial fine or suspend the player for the season. But, and this is key, what Chapter 11 reveals is that historically within the RBI, this wasn't how things were structured at all.
Not at all. What's fascinating here is that historically, the referee on the field was also acting as the disciplinary committee in the boardroom.
Yeah, really?
Yeah. The process of taking penal action, specifically imposing monetary penalties under statutes like the Banking Regulation Act or the RBI Act, it was spread out across numerous regulatory and supervisory departments.
Oh, man.
So if a cooperative bank broke a rule, the department supervising cooperative banks decided the punishment. If a commercial bank broke a similar rule, a completely different supervisory department decided their punishment.
I mean, that just sounds like a recipe for absolute chaos. If I'm the one writing the rules and monitoring your day-to-day compliance, and I'm also the one deciding your exact financial punishment, the potential for inconsistency is just staggering.
It's massive.
It relies entirely on the subjective judgment of whichever specific department happens to be holding your file.
You've identified the exact vulnerability that prompted the creation of the EFT. The text makes it very clear that an effective system of banking supervision relies heavily on robust enforcement. And robust enforcement requires a unified, well-articulated policy.
Makes sense.
The RBI recognized that having the supervisor act as the enforcer was not aligning with international best practices. When enforcement is scattered, you just lose objectivity.
Right, you get different rules for different players.
Exactly. You risk a lack of consistency where identical violations are penalized differently based purely on departmental silos. So by establishing a centralized enforcement department, the RBI aimed to ensure that enforcement actions became objective, consistent, transparent, and predictable across all regulated entities, which ultimately better safeguards financial stability.
It's like the difference between a local sheriff deciding the law on the fly versus a centralized court system with established precedents. So if separating these powers was such an obvious structural improvement, I'm really curious about the timeline.
Yeah, let's look at that.
How exactly does a massive central bank restructure its disciplinary powers? Looking at the chronology provided in the chapter, this wasn't just an overnight flip of a switch. It was a highly calibrated, multi-year rollout.
And this timeline is a critical area for exam preparation because it illustrates the RBI's strategic approach to risk management. The chronology maps a very, very deliberate expansion of the enforcement net.
Okay, lay it out for us.
The foundational moment, the spark, occurred on April 5, 2016.
What exactly happened on that day?
During the first bi-monthly policy statement for the year 2016-17, the Board for Financial Supervision, or the BFS, formally approved a supervisory enforcement framework.
Okay, so a framework,
Yeah.
not the department itself.
Right. This wasn't the creation of the department. It was the approval of the concept. It established the urgent need for a framework built on transparency, consistency, severity, and timeliness, all while strictly adhering to the principles of natural justice, which we'll get to.
So April 2016 is the intellectual agreement that the old, scattered way just isn't working. But it takes them almost a full year to take the next public step.
Yes, it does. On February 8, 2017, during the sixth bi-monthly policy statement, the RBI made the official announcement regarding the establishment of a separate enforcement department.
Okay.
And then shortly after that, on April 3, 2017, the EFD was officially established and basically opened its doors.
But when they opened those doors in April 2017, they weren't policing the entire Indian financial system right out of the gate, were they?
No.
The text indicates they started with a very specific, concentrated focus.
Initially, the EFD's mandate was limited solely to imposing monetary penalties on scheduled commercial banks, or SCBs, and specifically dealing with violations under the Banking Regulation Act and the Prevention of Money Laundering Act, the PMLA.
That strategy is fascinating. They didn't test this brand new centralized system on the small players. They went straight for the apex predators of the financial ecosystem.
The commercial bank.
Yeah. And from a systemic risk perspective, that makes total sense. I mean, if a tiny cooperative bank fails, it's a local tragedy. But if a massive commercial bank fails because of systemic noncompliance, it can drag the entire national economy down with it.
Exactly. You deploy your most potent new regulatory tool where the risk of contagion is the highest. Once they had the commercial banks under the EFD's purview, they focused on solidifying the internal rules. On October 9, 2017, the formal enforcement policy framework was drafted and placed before the BFS. This laid the operational groundwork for what was to come next, which was the massive expansion of their jurisdiction.
Right, because looking at the timeline, exactly 1 year later, on October 3, 2018, the floodgates open. The EFD's purview is expanded to include cooperative banks and non-banking financial companies, the NBFCs.
That's right.
Now, logically, this represents a monumental shift in the sheer volume of their workload. You're going from dealing with a relatively consolidated list of major commercial banks to suddenly monitoring thousands upon thousands of cooperative banks and NBFCs spread across every corner of the country.
The logistical challenge of that expansion was immense, which is why the next chronological milestone is a structural change rather than a policy change.
Okay, what happened?
In May 2019, to handle this massive influx of smaller entities, the RBI was forced to decentralize the EFD geographically. They established 6 regional offices.
That makes a lot of sense. You can't run enforcement for every tiny rural cooperative bank out of one central office in Mumbai. You need boots on the ground, or at least administrative hubs, closer to the entities they're policing. So May 2019 brings regional expansion, and then the jurisdiction just keeps growing.
It does. Just a few months later, on August 9, 2019, the National Housing Bank Act was amended. The regulation of housing finance companies, HFCs, was transferred directly to the RBI, and consequently, the enforcement actions against them fell immediately to the EFD.
Wow, they are really piling it on.
Yeah, and given all these new entities, cooperatives, MBFCs, housing finance companies, the overarching policy needed an update. So on September 25, 2019, a revised enforcement policy framework was approved by the BFS. And shortly after, on December 13, 2019, this updated policy was formally placed before the Central Board for information.
So by the end of 2019, the EFD has effectively consolidated its power over traditional lending institutions, commercial banks, NBFCs, co-ops, housing finance.
Pretty much the whole traditional block.
But the text shows the evolution continuing and into the modern digital era. On June 28, 2022, their mandate was extended to include credit information companies, the CICs, and then we hit the final, most recent milestone in the text, which is April 1st, 2023. Enforcement-related work under the Payment and Settlement Systems Act, the PSS Act, was officially transferred to the EFD.
Correct.
Now, hold on. Let me get this straight. April 2023 for payment systems.
Yep.
Anyone paying attention to the Indian economy knows that digital payments, the UPI revolution, mobile wallets, payment aggregators were absolutely exploding long before 2023. The volume of digital transactions was staggering for years prior to that. Why on earth did the RBI wait until 2023 to bring payment system operators under the centralized EFD umbrella?
It is a vital question, and it speaks directly to how central banks manage emerging technologies versus traditional risks. It comes back to that philosophy of tackling the most systemically critical foundations first.
Okay, unpack that for me.
Well, when the EFD was being built in 2017 and expanded in 2019, a massive compliance failure in a commercial bank or a major NBFC posed a clear, present, and historically proven danger to the economy.
Right. A bank run is a known entity.
Exactly. Payment systems, while scaling at a breathtaking pace, were still structurally evolving. Their specific regulatory frameworks were constantly being updated. The RBI needed to ensure the EFD was fully operational, its legal processes were pressure tested, and its regional infrastructure was capable of handling volume before assigning it. The highly complex, technologically dense world of payment operators and credit bureaus.
I see.
You don't ask a newly formed disciplinary committee to referee a game where the rules are still being written, You wait until the framework is mature.
That makes a lot of sense. You build the foundation with the heavyweights, and once the concrete is dry, you start bringing in the specialized tech entities. Okay, now, as we transition from the timeline to the actual mechanics of the department, we need to talk about the language they use.
Yes, the vocabulary is crucial.
Chapter 11 introduces a highly specific vocabulary. So if you're taking notes, let's build out the terminology section of our blueprint. because if you don't understand the strict definitions of these terms, you really can't understand how the power is actually wielded. Let's start with the most basic word, enforcement. We use it casually all the time, but the text has a strict definition.
It does. In the context of this specific regulatory framework, enforcement is defined strictly as dealing with cases of non-compliance with regulations noticed, either through the supervisory process or otherwise.
Or otherwise, that's an interesting catch-all phrase.
It is, isn't it?
It implies that while the supervisors are the primary scouts finding violations during inspections, the enforcement department can also act on, I don't know, whistleblowers, media reports, or other intelligence outside the formal inspection cycle.
Precisely. It allows the EFD to remain agile. Now, the mechanism by which they act brings us to a foundational term you need to know: the show cause notice.
Whenever I hear show cause notice, it sounds incredibly formal, almost like a courtroom summons.
It essentially is a summons, because the enforcement mechanism operates as a quasi-judicial process.
Okay.
A show cause notice is a formal, written communication issued directly to a regulated entity. It explicitly details the observed violation and demands that the entity show cause, meaning provide a valid explanation or defense as to why penal action, such as a monetary fine, should not be taken against them.
Right.
It is the legal mechanism that triggers the entity's right to defend itself, adhering to what the text prominently refers to as the principles of natural justice.
The principles of natural justice. That phrase is crucial. I bold that in my notes. It's the bedrock of modern legal fairness. It means you cannot act as a dictator in the dark.
Absolutely not.
You can't just spot a violation on a spreadsheet and instantly drain funds from a bank's account as punishment. You must give the accused a fair and transparent hearing.
Exactly. Under these principles, the regulated entity is legally entitled to a reasonable opportunity to be heard. They can respond to the show cause notice in writing, laying out their defense. Furthermore, if they request it, they must be granted the opportunity to present their case orally before the decision makers.
Oh, an actual hearing?
Yes, this ensures the regulatory power isn't wielded arbitrarily.
And once that entire process plays out, so the notice is issued, the written defense is submitted, the oral hearing takes place, we arrive at the next key piece of terminology: the speaking order. What makes an order speak?
A speaking order is the final, tangible output of this quasi-judicial process. It is a well-reasoned document issued by the adjudication committee.
Okay.
It cannot simply state, "You were found guilty and fined X amount." A speaking order must explicitly indicate the specific enforcement action being taken, and critically, it must clearly detail the exact reasons, logic, and evidence that led to that decision.
Ah, so it has to show the work.
Yes. It speaks for itself by providing a transparent, logical justification for the penalty, demonstrating that the defense was heard and considered, even if it was ultimately rejected.
It creates a paper trail of accountability. If the RBI is going to levy a multi-million rupee fine, they have to show their math. But that brings up a massive logistical question for me.
What's that?
Between the commercial banks, the NBFCs, and the payment systems, the RBI supervisors must find thousands of minor infractions every single year, right? A delayed report, a misspelled name on a form, a minor calculation error. They can't possibly issue a formal show cause notice and hold a hearing for every single typo. How do they filter the noise?
That's a great question. The EHD receives a massive influx of inputs. You've got on-site inspection reports, scrutiny reports from supervisory departments, market intelligence, and direct references from the RBI's top management.
That's a lot of data.
It's a mountain of it. They must filter this raw data into what the text defines as actionable and non-actionable violations.
Okay, so what pushes a violation across that line into the actionable territory?
It hinges on two primary elements: the fact of the violation and the materiality of the violation.
Go.
The fact is the baseline. Can you definitively prove that a specific statutory provision or regulatory directive existed and that the entity objectively breached it? But the true filter, the concept you absolutely must master for the exam, is materiality.
Materiality of violation.
Right.
Okay, if you're building a mental map of this chapter, put a giant star next to this term. It is the crucial metric for deciding whether to drop the hammer, and the text defines it using 3 exact parameters. It's almost like a 3-dimensional matrix to measure how bad a breach really is.
The 3 parameters defining materiality are extent, frequency, and seriousness. Let's break them down.
Let's do it.
First, extent. This measures the physical or quantitative reach of the breach. For example, if a bank exceeded a regulatory limit on a certain type of lending, by what exact percentage did they exceed it? Or, Consider the geographical extent. A procedural violation happening in a single rural branch is vastly different in extent from a systemic violation occurring simultaneously across 500 branches nationwide.
Right. So extent is basically the blast radius. What about frequency?
Frequency evaluates the pattern of behavior. The EFD asks, are there multiple instances of this exact same violation within a given sample size?
I see.
They're distinguishing between a one-off clerical anomaly, which might just warrant a supervisory warning, and a systemic recurring failure that indicates a broken compliance culture.
And the final parameter is seriousness. Now, how does the RBI quantify how serious something is? I mean, isn't that subjective?
Well, seriousness is often evaluated in strict financial terms. It looks at the absolute monetary amount involved in the violation,
Yeah.
but crucially, it also views that amount proportionally.
Proportionally. How so?
A 10 million rupee compliance failure might be categorized as incredibly serious for a small, localized cooperative bank, potentially threatening its solvency. But that exact same absolute amount might be viewed as a less critical, non-systemic issue for a trillion rupee commercial bank.
Right. Got it.
Mm.
It's all relative to the size of the entity. But the text also mentions aggravating factors that can instantly dial up the seriousness rating, regardless of the money involved, right?
Yes, seriousness is heavily aggravated by a history of repeat violations or persisting violations where the entity was warned but failed to correct the course over time. But the most severe aggravating factor mentioned is false compliance.
False compliance,
Right.
meaning the supervisor caught you, you promised, you fixed the issue, you submitted paperwork saying you fixed the issue, but in reality, you did absolutely nothing. You basically lied to the central bank.
Exactly.
I can see why that would trigger an immediate, severe enforcement action. It strikes at the very heart of the regulatory trust. Now, here's where it gets really interesting, though. With all this intricate talk of natural justice, formal hearings, and massive penalties, a listener might naturally assume that the enforcement department is the ultimate authority to call if their personal bank treats them terribly. Like, if a bank illegally forecloses on your house or drains your account through hidden fees, surely you call the EFD, right? But the text is completely explicit, and this is highly testable. The EFD is absolutely not a customer service desk.
That is a vital distinction to make. The text states clearly that enforcement does not handle individual consumer grievances.
It is not a mechanism for individual restitution. If a bank scams you out of 1,000 rupees, the EFD is not going to issue a show cause notice to get your money back.
No, they are not.
The EFD is a systemic, macro-level penalty mechanism. They are designed to punish institutions for breaking the structural rules of the financial system, not to mediate retail disputes. If you have a personal issue, you go to the RBI Ombudsman. If a bank is structurally failing to protect millions of accounts, that's when the EFD steps in. You got to keep that macro versus micro distinction crystal clear for the exam.
Exactly. The EFD monitors the structural integrity of the forest, while the ombudsman handles the individual trees.
That's a great way to put it. Now that we understand the timeline and the vocabulary, let's look at the actual people involved. Let's build out the important figures and names section of our blueprint. Who are the actual architects and judges pulling the levers in this enforcement machine? We have a few key acronyms to lock down.
The first major body to know is the BFS, the Board for Financial Supervision. You can conceptualize them as the overarching architects of the enforcement policy. As we saw in the timeline, they are the subcommittee of the Central Board that approved the initial supervisory enforcement framework in 2016, and they are the ones who approve the revised policies when the jurisdiction expands.
So they write the playbook.
Right. They
Yeah.
dictate the strategic how and why of the enforcement philosophy.
And sitting above the BFS is the Central Board itself. The text notes that revised enforcement policies are placed before the Central Board for information. They are the ultimate governing authority of the Reserve Bank, keeping an eye on the overarching trajectory of financial regulation, even if they aren't the ones down in the weeds drafting the specific enforcement matrices.
Precisely. Then, moving from the policymakers to the operational level, we have the adjudication committee.
Ah, the judges.
Yes, these are the individuals who actually execute the quasi-judicial process.
Yeah.
They are the judges in our courtroom analogy. They are the ones who read the show cause notices, evaluate the written defenses, preside over the oral hearings, and ultimately issue the binding speaking orders.
We'll get to the exact headcount of that committee in a moment, but before we leave the figures and names section, there's one very specific academic citation in Chapter 11 that we really have to discuss.
The Delhi study.
Yeah. It's incredibly rare for a regulatory text to just drop a random academic study into its conclusion, unless it is fundamentally central to their philosophy. The text specifically cites a 2016 study by Delis, Staikouras, and Sumas titled Formal Enforcement Actions and Bank Behavior. Why does the RBI dedicate space to this specific paper?
If we connect this to the bigger picture, the RBI is using this study to justify the very existence and, more importantly, the highly public nature of the enforcement department. The study empirically proves a concept known in behavioral economics as the demonstration effect.
The demonstration effect, let's really break that down. How does it work in the context of banking?
Well, the study suggests that when a regulator takes formal public enforcement action against one specific bank, the impact is not isolated to that single institution. The public penalty acts as a massive psychological and behavioral deterrent that favorably modifies the risk-taking behavior of all the non-sanctioned banks in the ecosystem.
Oh, I see. It's like the highway speeding ticket analogy.
How's that?
If you were driving down the highway doing 20 miles over the speed limit and you see a police car with its lights flashing pulling over another driver, what is the very first thing you do? You instantly slam on your brakes and check your speedometer.
Every time.
The police officer didn't pull you over, but the public demonstration of enforcement instantly altered your behavior.
That is precisely how it works in the financial sector. When Bank A gets hit with a highly publicized speaking order and a massive multi-million rupee penalty for, say, a critical failure in their cybersecurity protocols, the CEOs and compliance officers at banks B, C, and D don't just read the news and move on.
No, they panic.
Exactly. They immediately initiate internal audits. They scramble to fix their own cybersecurity frameworks out of fear that they are next on the EFD's list. The RBI isn't just citing this study to be academic. They are stating a core operational strategy. Enforcement isn't merely about collecting fines after a rule is broken. It is a proactive, systemic tool used to shape the future behavior of the entire market through the threat of public consequence.
Make an example of one to educate the thousands. It proves that a centralized, transparent enforcement mechanism is actually a tool for preventative supervision. Okay, let's pivot to the hard data. For anyone taking an exam on Chapter 11, you absolutely need to know the specific numbers.
Yes, the quantitative data.
Let's extract the vital statistics and empirical data into a rapid-fire section of our blueprint. Let's start with the geographical footprint we discussed earlier.
Okay. In May 2019, to handle the massive influx of cooperative banks and NBFCs, the RBI created exactly 6 EFD regional offices. You must memorize these specific locations: Ahmedabad, Chennai, Kolkata, Mumbai, Nagpur, and New Delhi.
It's a strategic distribution across the major financial hubs of the country. Next vital statistic: the composition of the adjudication committee. You need to know exactly who sits in the judges' chairs, and the text draws a strict distinction depending on whether the adjudication is happening at the central office in Mumbai or out in one of those regional offices.
Right. At the central office level, the adjudication committee consists of exactly 3 executive directors. And there's a critical caveat to remember. One of those 3 must be the executive director in charge of the EFD.
3 executive directors at the center. What about at the regional level dealing with the smaller co-ops and NBFCs?
At the regional office level, the committee composition shifts. It consists of 1 regional director plus 2 senior officers.
Okay, 6 offices, 3 EDs centrally, 1 RD, and 2 senior officers regionally. Now let's move to the international empirical data provided in the text box regarding the European Union.
Yes, the EU comparison.
Chapter 11 goes out of its way to show you what enforcement looks like outside of India. This is highly testable because it provides a stark, quantifiable contrast to the Indian system. What are the specific penalty limits in the EU?
The European Central Bank, the ECB, wields staggering financial power when it comes to enforcement. According to the text, for a significant institution, the ECB can impose penalties up to twice the amount of the profits gained or the losses avoided because of the regulatory breach. Or, alternatively, they can impose a penalty of up to 10% of that institution's total annual turnover in the preceding business year.
I really want to pause and emphasize the sheer terrifying scale of that number. 10% of total annual turnover.
It's massive.
If a major global bank operating in the EU generates 50 billion euros in turnover, a single catastrophic compliance failure could theoretically result in a 5 billion euro fine. That isn't just a penalty, that is an existential threat to the institution's operating margin. It completely changes the calculus of risk for a banking executive. The text includes this specific, massive data point to help you remember the philosophical difference in global enforcement. In India, as we'll explore shortly, penalties are tapped by specific statutory limits written into laws. But that EU data point, twice the profit gain, or 10% of turnover, is a specific quantitative metric you need to burn into your memory.
It highlights a fundamental divergence in regulatory philosophy.
Hmm.
Statutory fixed limits versus dynamic, percentage-based limits tied to the overall size and success of the institution.
Which brings us perfectly to the next phase of our blueprint. Memorizing the dates and the 10% turnover rule is necessary, but it's not sufficient for true mastery. You must understand how these facts connect.
Right, the why.
Let's map out the critical cause and effect relationships detailed in the chapter. Exam questions love to test your understanding of why an action was taken, not just what the action was.
Let's trace the primary architectural driver for the entire chapter, cause. Historically, enforcement functions and the power to levy monetary penalties were scattered across various regulatory and supervisory departments within the RBI.
Right.
Effect. This fragmented structure resulted in a process that inherently lacked uniformity, consistency, and predictability. This critical vulnerability prompted the RBI to create the Centralized Enforcement Department, aligning itself with the international best practice of firmly separating the supervisory function from the enforcement function.
It's the exact problem and solution we discussed with the sports analogy. Here is the second crucial cause and effect chain regarding logistics. Cause. In October 2018, the EFD's purview was drastically expanded to include cooperative banks and NBFCs. This massively exponentially increased the raw volume of regulated entities under their watch. Effect. The RBI quickly realized that a single central office in Mumbai couldn't possibly handle the load without creating an enormous administrative bottleneck. Consequently, they decentralized the EFD geographically by establishing the 6 regional offices in May 2019 to maintain operational efficiency and ensure that smaller entities didn't just, well, slip through the cracks.
The third chain deals with the legal and procedural nature of the department. Cause. By its very definition, the enforcement mechanism is a quasi-judicial process. This classification inherently demands strict adherence to the principles of natural justice.
The fairness doctrine.
Effect. Therefore, the RBI is legally mandated to operate transparently. They must issue a formal show cause notice detailing the allegations. They must provide the regulated entity with a reasonable opportunity for a hearing, either written or oral. And finally, the adjudication committee must issue a well-reasoned speaking order that justifies the penalty. The cause, the legal nature of the power. The effect is the rigid, protective process.
And here is the final cause and effect relationship. I'd argue this is the most testable one because it involves a very specific solitary exception regarding the finality of the RBI's power, cause. The RBI imposes a monetary penalty on a bank using the powers granted to it by its primary governing acts, specifically the Banking Regulation Act, the RBI Act, or the Payment and Settlement Systems Act. Once the adjudication committee issues that speaking order, the regulated entity has absolutely no avenue to appeal or review that order within the Reserve Bank of India. The decision is final.
That's right.
Wait, hold on. Let me get this completely straight. If I run a major commercial bank and the EFD hits me with a massive multi-million rupee fine for a compliance error, there is no appeals process. There is no higher court or appellate tribunal within the RBI that I can go to and say, hey, the adjudication committee got this wrong. Please take a second look.
Under almost all the overarching statutes governing the RBI's power, no. The text is definitive on this point. The RBI is not empowered to entertain any appeal against the adjudication committee's order. The process is exhaustive on the front end with the show cause notice and the hearing. But once the speaking order is issued, the internal process is complete.
That is a staggering amount of finality, but you mentioned an exception.
Yes, and this is exactly what examiners look for. The text highlights one singular, specific statutory exception. If the monetary penalty has been imposed under the Sarfazi Act, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, then, and only then, is an appeal or review possible.
Why Sarfazi? Why is that the one outlier in this entire centralized system?
It comes down to the nature of the act itself. Sarfazi deals with the securitization of assets and the enforcement of security interests, essentially, how banks seize collateral when loans go bad.
Foreclosures and property.
Exactly. Actions under this act often involve highly complex, multi-party disputes over property rights and asset valuations, which are inherently more legally entangled than a straightforward breach of a central bank liquidity ratio. Therefore, the statute provides a mechanism for review. But for standard regulatory breaches under the BR Act or the RBI Act, the EFD's word is final. If you are memorizing associations for the exam, burn this into your mind. Associate Sarfazi with the sole exception of appeal possible.
Excellent point. Sarfazi is the outlier. Now we have arrived at the final synthesizing piece of our blueprint, the comparative matrix. So what does this all mean? To truly grasp the uniqueness of the RBI's framework, you need to understand the international context provided in the chapter's specific text box. We've talked about India and touched on the EU, but let's formalize this. Let's construct a mental table comparing the United States, the European Union, and the Indian models based strictly on the parameters provided in the text.
Okay, imagine a massive table with 3 columns. We're going to evaluate each jurisdiction based on 3 criteria: their structural design, how they classify severity, and the nature of their penalties. Let's start with column 1, the United States.
Okay, the U.S.
Structure. The U.S. regulatory model is highly fragmented. Powers are not centralized. They're divided among numerous federal and state agencies. You have the Federal Reserve, the Federal Deposit Insurance Corporation, or FDIC, the Office of the Comptroller of the Currency, the OCC, and the Consumer Financial Protection Bureau, the CFPB.
That's a lot of acronyms.
And furthermore, if the misconduct crosses into criminal or anti-competitive behavior, the Department of Justice gets involved.
It sounds like a labyrinth. If you are a bank in the U.S., you have 5 different federal agencies breathing down your neck. Okay, what about severity?
Severity.
Yeah.
Because of this fragmentation, they utilize a specific classification system. Violations are categorized into distinct tiers, Tier 1, Tier 2, and Tier 3, based on the gravity and systemic threat of the offense.
And the penalties.
Penalties. The U.S. utilizes a wide spectrum of actions. They use non-monetary actions like public cease and desist orders, but their civil money penalties are famously severe, capable of running into millions of dollars per day, continuously, depending on the assigned tier.
Millions per day. Okay, column 2, the European Union.
Structure. The EU uses a bifurcated system under what is called the Single Supervisory Mechanism, or SSM. It splits the workload based on the size of the entity. The central authority, the European Central Bank, directly handles the significant institutions. The national regulators, known as National Competent Authorities, or NCAs, handle the less significant institutions within their own borders.
And the severity and penalties?
Severity and penalties. As we discussed earlier, their penalty structure is proportional and massive. It is not tiered like the U.S., it's percentage-based, up to 10% of total annual turnover, or twice the amount of profits gained or losses avoided.
And finally, column 3, India, under the Reserve Bank of India.
Structure. Standing in stark contrast to the highly fragmented U.S. system or the bifurcated EU system, India's model is unified and centralized under a single enforcement department. The regional offices exist purely for logistical volume management, not as separate regulatory authorities.
Right.
Severity. India does not use the U.S. system of tiers 1, 2, and 3. Instead, severity is determined by the specific materiality matrix we explored earlier, carefully evaluating the extent, frequency, and seriousness of the breach.
And their penalties.
Yeah. Rather than the dynamic, percentage-based turnover fines seen in the EU, Indian monetary penalties are strictly subject to the maximum limits explicitly stipulated in the respective governing statutes, like the Banking Regulation Act or FEMA. And, crucially, with the sole exception of Sarfazi, there is no general right of appeal within the RBI.
Let me concisely recap this matrix so you have a perfectly clear, high-contrast mental image. The U.S., a fragmented structure, tiered severity classifications, and massive millions-per-day fines. The EU, a bifurcated structure based on significance and proportional, terrifying 10% turnover fines. India, a centralized EFD, a materiality-based severity matrix, and strict statutory penalty limits with virtually no internal appeals. Keep those distinct characteristics clear, and you will dominate any comparative analysis question they can possibly throw at you.
This structured comparison is vital because it reveals that the RBI's framework wasn't created in a vacuum. They looked at the fragmented U.S. system and intentionally chose centralization to guarantee consistency. They looked at various global penalty structures and chose a highly defined, 3-pronged materiality matrix to ensure objective fairness within their own strict statutory boundaries.
And with that, we have completed the entire architecture of our blueprint. If you have absorbed this conversation, you now possess a complete, structural, and deeply nuanced understanding of Chapter 11. You don't just know that the EFD was created in 2017. You understand the profound philosophical shift from scattered supervision to centralized objective enforcement.
Exactly.
You understand the exact parameters of materiality, extent, frequency, seriousness. You know the timeline of expansion from commercial behemoths to digital payment systems. You know the exact composition of the adjudication committees, the strict legal necessity of the show cause notice and the speaking order, and exactly how India's centralized model contrasts with the US and the EU. You don't just know the what, you know the why and the how.
Which is exactly what is required to move beyond rote memorization and achieve true analytical mastery of the subject matter.
But before we sign off, we want to leave you with one final provocative thought to mull over. It's based on a very specific detail tucked into the conclusion of the text, and it kind of challenges the ultimate effectiveness of everything we just discussed.
Oh, the individual liability issue.
Yeah. Currently, the overarching laws that enable the RBI to undertake these enforcement actions, the BR Act, the RBI Act, they empower the central bank to impose monetary penalties only on the regulated entities themselves. The bank pays the fine. The NBFC pays the fine.
Meaning, the RBI cannot currently impose these financial penalties directly on the individual human beings, the executives, the board members, the compliance officers who actually made the decisions or were responsible for the negligent violations.
Exactly. It raises a profound question about moral hazard and the true nature of deterrence. So ponder this as you continue your studies. If a bank pays a massive multi-million rupee fine for breaking the rules, but the specific executive who authorized that highly profitable, non-compliant behavior faces absolutely no personal financial penalty from the regulator, well, how truly effective is the deterrent?
It's a great question.
If the machine breaks the rules, the central bank fines the machine, but the operator walks away untouched. It's a fascinating gap in the regulatory armor to think about. Good luck on the exam.